Thanks, guys. Thanks for turning up. As I usually, it's my standard joke. It wouldn't be much fun if I was the only one who would join here because it would be a very lonely experience. So it takes two to tango, and I'm very happy to see that I won't be the only one dancing to the music today. I've had quite some questions in advance. First of all, my apologies. I know that some of you have been asking to do this more regularly and more earlier as well. Sometimes time is not always on our hands, and maybe I can hereby promise that we will do this more often, even maybe not as often as you would like me to do. But nevertheless, let's get right into it. I've already received questions. We're going to start with those, of course. The other thing is, feel free to send in messages on the messaging system. I have access to it on my side in the view, and obviously I will try to be as thorough as possible and to go through as many topics as possible. Questions I've received so far, they range from BHP, Woodside, CSL, Telix Pharmaceuticals, CommBank, and CommBank was actually a little bit of a broader question. It also involves the likes of Wesfarmers, Medibank Private, Telstra, and the likes. But I have two other ones that I probably want to take first, and one I thought was a very very cute one. It's basically a question from someone who wants to buy shares for a grandson or for a grandchild and keep them for 5 to 10 years. And then the question to me is, which shares would you suggest, Rudy? That actually is more difficult than you would think it is, and that might be a little bit of an odd answer from someone who likes to buy and hold shares for a very long time, and who's obviously very much focused on finding those companies that can grow in, year out. I'll relate back to two of my experiences to explain why that is not as straightforward as you would think. X amount of years ago, I decided to buy some shares for my two sons. I have two sons, and I decided I'm going to spread it out over 4 shares, two each, and I bought CSL, ResMed, Technology One, and NextTC. And that was years ago. I think on average, both of my sons are pretty happy with how that's gone. But in the meantime, a lot of stuff has happened. We've had the GLP scares for ResMed, which has temporarily put the share price well below where it was purchased. The share price now has doubled. We have had pressure on CSL share price, US tariffs, and anti-vax movements in the US. We have had a skepticism creeping in for data centers with regards to NextCC, which is sort of happening this year. The only one who hasn't been hit so far is Technology One, and that obviously has performed absolutely fantastically. But what I took away from that experience is, and of course, both of my sons will keep those shares for another 5 to 10 years, I hope, unless something happens in between that makes us review that trajectory again. And that, I think, is the important thing. So about 10, 15 years ago, I had a similar question from someone, and I said at the time, give your daughter shares in Macmillan Shakespeare. And that subsequently didn't turn out that well because the Labour government later onwards changed or targeted the sector, and it never really became on the same trajectory for that company. And that, I think, is the essence. If you buy shares for 5 to 10 years, you sort of, it's nice in theory, but you sort of have to be prepared to review those shares every few years, because things can happen over 10 years, even with the likes of the companies I just mentioned. And surely at some point, something can happen with Technology One as well. And that's sort of my my hesitance in getting people on that path. So in modern times, if you want to buy shares and keep them for 15 years or longer and as a present to your grandchild, I would actually think nowadays maybe the better part is to do it through an ETF, because your risk is much lower that if something goes wrong, even though it's temporary, on an individual basis. And the ETFs, I would personally think if you want for longer term, would be the high quality international ones. And you have a few that specifically target high quality companies international, and I would maybe that would be my preference. But by all means, feel free to copy the 4 shares I gave my sons, because there's a reason why I gave them to them. Another more difficult question I received as well is which companies I think will surprise in the upcoming reporting season. And yes, we all want to know, of course, we all want to know which one's going to surprise. I've been doing this for quite a while. You don't see a beard, but that's because I shave. But and the longer I do this, to be honest, the less confident I feel in predicting which share prices will rally and which share prices will not rally and go the other way in reporting season, because you simply don't know. That's the long and the short of it. My personal approach to reporting seasons these days is that I tend not to make such forecasts. If you want to have those forecasts, please read my stories either on the Mondays or on the Thursdays, because I do line up all the expert predictions about what they think is going to surprise and disappoint in August. And on my observation, they do get it right in a number of times, but they also get it wrong in another number of times. And that is because that you never really know what will come out of companies and what will be the market's response. Sometimes a disappointment is treated as not so bad. Sometimes the slightest miss can see the people running for the hills, and share price getting clobbered. I think that the unpredictability is just too high. But what I would say, and this is how I approach reporting seasons these days, I go in with an open mind. Sometimes I might take off a little bit money off the table. I'm not doing that this year because the portfolio has about 10% in cash, so we can utilize it. And what I do is when companies report in reporting season, and then depending on what happens, and that's not the share price, by the way. That's not only the share price. That also is on the basis of what do they actually report, what's the importance of it, and on that basis. And sometimes I do take my time. I do take a few days, or maybe some even longer, and I just literally make a decision of, does this company deserve to be in the portfolio? Maybe I should add some more shares. Maybe I should take some shares off. And that's basically how I observe portfolios in reporting season these days. And as a long-term investor, I think that's probably a better way than trying to forecast what the share price will do in advance, because that tends to be a little bit of a hit and miss show. And it doesn't matter whether you use technicals or you are very well versed in certain companies. Share market is at all-time highs. I personally think that the season comes a bit too early to expect too much, in particular from the part that hasn't performed yet, and that means that August might actually get quite tricky, and we all should be prepared to see a lot of volatility kick in. And if it doesn't happen, oh, that's good news in a sense. I see there's one question coming in, and I might throw it in. Someone says, my view
Well,
on
you times,
WiseTech and
right?
Life
I
360.
don't know about it, and so
And again,
you drive over and
it's
take a
in
look at
regards
it.
to the reporting season.
Could you find it?
I do think that
I
someone
found it,
has
but the
their
first one I
microphone
saw
on.
was I was up there
So I'm
on
going to
Main
ask
Street,
everyone
and
to
all I
keep their
saw was
microphone off.
the
There's
road.
at least
And I
someone
went
who
down,
has,
I went down there. I did see the view that I've seen in the picture.
and I think I found the person. So that sound in the background is now silenced. Views on WiseTech and Live 360 again, and also, but and in the fact that the share price has run hard and in reporting season. I'm a shareholder or the portfolio is a shareholder in WiseTech, not in Live 360. That is simply a choice that you can't own them all, and you have to make a decision. You can only own a limited number of stocks. But I think we all agree. I have been quite supportive of Live 360 for a while. It's one of those companies that simply continued to surprise to the upside and to meet expectations, also as expressed by management. The problem with both is, well, one is a small cap, the other one is a large cap. That's a future top 20 stock, WiseTech, I believe, in Australia. It's now a top 50. Volatility is going to kick in, and how we are going to respond with that is a personal choice. I read recently that the average share price response of the share price in WiseTech over the past reporting seasons has been on average 15% on the day. So volatility can definitely kick in. The portfolio currently is not fully invested in WiseTech. We took some off the table late last year when the share price was a lot higher, and we sensed that more bad news was going to come out because of the founder, CEO at the time. Now that view proved correct, but I'm also of the view that you don't sell out completely out of these companies because they, similar as with Pro Medicus, for example, they can run before your eyes and you don't get on board again. So I am prepared to take the volatility on board, and if WiseTech shares do sell off, and the news is not of the kind that it completely destroys the trajectory forward, I'd be prepared to buy extra shares. That's very simple. Am I going to add Live 360? I'm not quite sure about that one. I mean, one of the things we need to keep in mind for reporting season is that it is well possible that the market will become less focused on technology and on AI, and will broaden out to broader parts of the market. Although I have to admit, I think it's quite early for Australia for that happening. It's happening in the US apparently. For Australia, I think it's early, but we have to keep in mind that if we invest, we have a longer view than the next week, next month, the next 6 months. For that reason, for example, you might want to consider looking into smaller caps that have not performed as strongly as Live 360 just yet. But do keep in mind also, sometimes companies look cheap for a reason. On this day today, we had a market update by Viva Energy. The share price did absolutely not look expensive, and it looks now cheaper. And that's because of the market update disappointed, of course. That in itself could also be a strategy, although my experience is buying subpar, low-quality companies upon disappointment could well be a way to more disappointment, essentially. Let's take on a few more of the questions I've received in advance. BHP and Woodside, what do I think when it's time to buy or when it's time to sell, was basically the question. I'm not a fan of both. Even apart from the mandate I've created for myself and for the portfolio, which basically is we try to seek out the highest quality companies, the quality growth companies, and we try to buy them at a price that still offers a lot of upside, and then keep them for a long time and see that upside coming towards us. So that obviously excludes cyclicals like BHP and Woodside. My favorite observation on Woodside is peaked at $73 in June 2008. Yes, it has paid dividends, but those dividends are very unreliable, and the share price now is 75% lower. or maybe 66. Maybe my math is not that great. But it is lower a lot, and it hasn't even been halfway in the decade since. I think energy is just a very, very difficult sector to, on a sustainable basis, make money out of. And I'm not a big fan of having energy stocks. BHP, there's a class of thinking that you should always have some BHP in the portfolio. I don't agree with that for the simple reason that yes, it is large. Yes, it has performed relatively okay throughout the years. But then again, the iron ore price has remained higher than expected, and you never know whether it's going to fall out of bed at some stage. The one reason, and I'm now looking beyond what's happening in the immediate outlook, the one reason I think you could consider owning BHP shares is because you're a copper bull, and the bull market for copper will arrive at some stage. It won't arrive in the next 6 months, I don't think. It's too early for that. But longer out, this is the largest copper producer in the world. There's a fair argument to be made that BHP is well managed and better quality than Rio Tinto. It gives you access and exposure to different set of commodities. Surely they're going to get Jansen Potash in Canada on the rails at some point, even though they had to postpone the second phase now, and they're going to spend more money on it. I can't get excited about it, but then the criticism you could throw at me is, I mean, I've been a shareholder in CSL for the past 5 years, and that hasn't been an exciting trip either. Now that we have touched about CSL, I did get the questions. Yes, I'm still a shareholder. The one thing we have done in the portfolio is it is no longer the largest exposure we have in the portfolio. We just dialed that back a little bit. The reason for that is very simple. It's not necessarily because the last 5 years have been disappointing. It's more to take into account risk. And at this point in time, still, we do not know what the crazy people at the White House, what they are going to do with pharmaceuticals and tariffs and the likes. There is definitely a lot of pushback against vaccines in the United States. The United States is a very important market for CSL. There's an argument to be made that CSL is actually more of an American company than it is not. But nevertheless, it is a multinational. It has operations in Switzerland, in Australia, and elsewhere. It can be hit. It's under the surface, believe it or not, under the surface, it is growing at double digits already, and expects to repeat that this year and in the years ahead. The margin increase, all else being equal, should come through, even though, just like in the case with BHP, it's going to be a little bit delayed than expected 2 years ago. I'm still happy to own CSL shares, and to my delight, I've seen that they're back above $270, coming from 240. So, and that all went very quickly. So clearly, for some reason, the market was more comfortable this month in owning CSL shares than before. There is an argument to be made, as I said in my writings as well, that money flowing out of the banks might well flow into healthcare instead of in resources. And I think, at least in July, we've seen some of it. In the background, meantime, as everyone is probably aware, I mentioned them earlier, the portfolio is a big fan of ResMed. ResMed, off their GLP-1 sell down lows, of course, is up 100% now. ResMed in recent weeks again is rallying quite firmly. Friday results expected to be strong, and that's the problem that I have with making those announcements or those preferences in advance. Given the share price already is rallying, is Friday still going to be strong enough to surprise to the upside? It can, but I have no magic magic ball to predict whether that's going to be the case. It may well be that the share price weakens on Friday simply because it has now rallied so strongly. But as a long-term shareholder, I actually don't really care. ResMed has sort of taken the position of CSL previously. It is one of the largest holdings in the portfolio. We're still happy to hold it. We obviously keep an eye out on what might happen at some point, positive or negative, with GLP-1s, but we're not that worried, to be honest. ResMed is a fantastic company, and I can only hope that lots of people who follow my research that they sooner or later um, uh, add such stocks to their portfolio. Telix Pharmaceuticals, I had a question in advance. I see a question that has been just freshly added. A few weeks ago, someone asked me, I'm thinking of selling some of my bank shares and putting them in Telix Pharmaceuticals. What do you think, Rudy? My question, my response was, well, as long as you're prepared that you will get more volatility in holding Telix Pharmaceuticals. And you may get a lot more than you are used to with stacking your money in banks. Now, that has proven to be quite prescient. Share price has sold off in the meantime. So what has happened is that the US authorities are doing some kind of investigation on exactly what happened. Plus, it would appear that their numbers didn't quite meet expectations. This is usually what happens with these young companies. It doesn't mean it's now become a bad investment. Telix had done a lot of things right, had become a little bit of a market darling over the past 2 years or so. A lot of people talking about it. A lot of people wanted to own shares in them. Personally, I don't own them. I keep an eye out because I tried also to keep an eye out on companies that perform, and maybe there's more to it than simply a temporary rally. I think Telix has a lot of potential. Of course, we don't know whether the potential will be fully maximized. I personally would think that if you owned Telix, that you stay on board and you just keep an eye out on the longer run. But in the short to medium term, you have to realize a lot of people now are sitting on losses. The investigations in the US can take a while. Market might get spooked. You never know. So the problem with smaller cap companies often is that small negatives can have really large impacts, and that's simply because of the size of the company. I mean, um, I I have companies in the portfolio. Let's pick one. Woolworths. If Woolworths were a small cap, the share price probably would be 30% lower. But because they are a large cap and people understand them and they have a big impact on the index, they're not 30% lower than where they are. And that's an advantage of owning larger cap companies compared with smaller caps. That's just the way it is. The question about CBA is probably the most talked about in recent times, I think. Normally, I follow CSL closely, and because I learn so much also from how the market responds and how people respond, because it looks like everyone, a particular while ago, everyone had their own reasons about what was happening with CSL. In similar vein, everyone has had their reasons and their rationale about what was happening um, with CBA shares. And I have to say, some of those narratives, they literally knock me off my perch. We humans, we are very good in just making stuff up as long as it fits in with our own worldview. Um, we have published quite a number of stories. I think there's two things happening with CBA, and they both came together in a way that literally propelled the share price to much higher highs. One of the things that people can't get their head around is that no matter how you slice or dice the local share market or the local banking sector, CBA, CommBank is the highest quality, head and shoulders above competition. And I mean, I can probably do a dedicated presentation in coming up with the metrics and the financial numbers to prove that. But just for the time being, just accept the fact that CBA CommBank is the number one bank in Australia, and it's not only because it has the most retail investors on the register who never sell. It is simply the best operator in that sector, and you will see in the years ahead also that when it comes to the employing and applying technology in the banking sector, that CBA will be best suited to do that exactly. And we are looking at towards AI, etc. Now, the other element is that the White House, with their tariffs, they've put the fear of God, so to speak, in a lot of local investors, also investors in Europe. And they too had some crazy ideas, which some of them have fallen off the perch by now, but you don't know really what might come out of the next 3.5 years over there. So some of those international asset managers, they have decided to park their money elsewhere. And if you manage billions and billions of dollars, parking $1 billion or $500 million in an Australian share market is small beer for you, but for the local market it makes a big difference. So we've seen some of that money flowing into Australia, and where do they go? Would they go into a cyclical like BHP? Very unlikely. Would they go into a healthcare stock like CSL? It could have done in the past, but CSL hasn't really been great, and there still are probably in a down cycle, and the share price hasn't moved 5 years. So that money has simply gone into the highest quality bank and also the highest quality large cap probably we have on the stock exchange, and it's come back. And that has pushed the share price so high. It makes sense, not from a standalone valuation perspective, but it makes a lot of sense if you take into account that they pay a healthy dividend, and still, although it's on American terms, it's still a nice dividend, and the American currency is weakening. So from a currency perspective, it makes a lot of sense if you don't reason in Aussie dollars. The American currency is quite an interesting one, because there's this narrative amongst investors that the US always outperforms Australia, but that's only the case this year if you don't correct for currencies. So if you judge the local share market and the US market as expressed in Aussie dollar, the local market is almost one-on-one with the US market, and that's how important the currency is in these considerations. So people internationally had no problems in putting their money in CBA, because they reason on a total return basis, and that's taking into account the currency as well. Now, CBA is not the only one that has benefited from these inflows. Essentially, what those managers were looking for is steady, reliable, sturdy, solid business models, high quality, not too much debt, dividend paying, and in Australian dollars, so you do get the currency hedge, and in a way that you don't have to worry that there's a profit warning coming soon. So the expectation is that other companies, like for example a Medibank Private, like for example a Telstra, and like for example a Wesfarmers, that they too have benefited from those inflows, just not to the same extent as CommBank. So that brings us to the question now is, well, if those shares are now higher than they otherwise would be, and maybe to a level where fundamentally you can't really justify it, what do you do as a shareholder? And that's an interesting one, because the longer one covers the share market, the more you realize that those corrections from fundamental values, they do not happen immediately by definition. And you never really know when they happen or how. But ultimately, the market will find a way of correcting what needs to be corrected. The outlook for the banking sector is not fantastic, but it wasn't fantastic in the year past either. But there are supporting factors that they remain in play. One of the things is that internationally, banks remain on the wish list of many investors, fund managers, asset managers. Deregulation in the US, AI is also expected to benefit this sector to a large extent. So it is well possible that those share prices of local banks that do not have much to offer in terms of dividends, growth, you name it, they do not necessarily correct to the downside. We'll just have to wait and see, I guess. And the same principle applies to the other companies. I mean, the portfolio is shareholder in Telstra and in Wesfarmers. I'm not at this point in time. We're keeping those shares. It's also probably fair to say that while the portfolio invests in quality and in growth, it's not simply weighed towards one end of the market. It's quite diversified. We do have Woolies in there. We have Telstra in there. We have shares like Dicker Data in there, shares that have not necessarily performed in recent times, and that could well start performing in times when those who have performed are encountering headwinds, and maybe the combination again might quite end up being a positive one. I do not have a view on Bitcoin. I'm still making up my mind there, and I also think that that's just a personal consideration as well. The origin and the existence of my research and of the all-weather portfolio is a lot more than simply making money. It also is part of me accumulating a lot of insights, getting different views, get a lot of experience, and exactly become a wiser man and a better investor myself. From that perspective, even if I were getting really excited about Bitcoin and the likes, I would probably keep that outside of the portfolio because I don't want to dilute whatever I'm doing with my research in equities by having Bitcoin on the register as well. You can see why that is. I mean, if I had a lot of money in Bitcoin and now my portfolio would have benefited a lot of that, how much would that help me in the research of all weathers? That's always an interesting consideration, of course. But at the moment, I haven't gone there. I haven't ventured there. I've made this comment in the past a number of times. I have this beautiful gene that when everyone is making money or doing one thing, I do not necessarily need to be there as well. So my neighbor can have a mansion, and I'm still happy living in my house, if that makes sense. And that helps me a lot also in the share market. When everyone is piling into Telix or another temporarily popular stock, then I can watch the whole thing, I can observe it, I can study it, but I do not need to be on the register too. I can bear it when other people are making money. There's also a question about my all-weather section, and I do realize that there's a question sitting in my inbox, which I haven't had the time yet to answer. And it is I have removed the defensive and the dividend payers as a category, and I have added a category of exposure to AI. And the reasoning And the reasoning behind that is that it's similar to when people ask me which shares would you buy for the next 10 years. I think people are too casual when you present them with defensives or with dividend payers. And more often than not, I find dividend payers they disappoint because weak share prices are usually the condition for having a decent yield, but that often goes with the fact that obviously they're not in the greatest form. Australian investors have been pampered with having a enormous decade in the 90s and in the noughties with the banks performing so well. I think, and the underlying message is that I will continue to point out, and I will find a way of bringing defensives and dividend payers under the intention of subscribers. And maybe one way of doing this is by simply communicating which parts of the portfolio that I run are defensives and are dividend payers, and that could be one way. But I think the main message that we want to get across, and myself as well, is that this is probably a repeat of the 1920s, share market wise, economy wise, and investment strategy wise. And we have set up a whole section dedicated to AI for that particular reason. I think with my research, one of the things I've done very, very well is added mega trends to the research into all weathers. And I think the message here is that you have to have attention. You have to put now effort and attention into AI because AI is the future. It really is that simple. This is not, in my view, this is by no means a repeat of the late 90s when we all got crazy about the internet and there was really not that much substance to it at that time. Ultimately, yes, but at that time it was all a bit overcooked. Can the current megatrends be overcooked at times? It will probably happen at times, and more in the US so than locally. But those share prices locally now, they look quite cheaply since that they've come down since the beginning of the year, and they all have very strong growth ahead of them. You can invest in AI through the data centers, or you can go through the technology companies. They both will give you plenty of growth. Ultimately, we published a story about the BHP already. They are using AI, and it has had effects on them, but they are cyclical. But ultimately, AI will go through the banking sector. It will go through the insurance sector. It will go through other sectors of the share market, and it will impact those companies. One of the ways of looking at the market is that when share prices or valuations look high, if growth comes through and if efficiency comes through AI, then those share prices don't look that expensive at all. And that is something we always have to keep in mind. I just got a question coming through on Ramsay Healthcare. And someone says, I have not been able to persuade myself to buy this one. I wouldn't, to be honest. I know Ramsay Healthcare quite well. It used to be part of my selection of all weathers in the Australian share market. I was very well aware of the time that one of the pillars under the great performance of this company at the time was the fact that it became international. It was expanding its network, its footprint, and there was a lot of synergies and a lot of advantages to be derived from that. Unfortunately, times have changed, dynamics have changed for that part of the healthcare sector for certain. I just it's similar with a company like AMP, which is now all of a sudden releasing positive results. It's a struggle. I mean, these are companies really in struggle street, and I think the main lesson any investor should take on board from the past 10, 15 years is that simply because a company has been great and it's now in struggle street and therefore cheaper priced, it doesn't mean it's going to give you great results, great returns. Yes, Ramsey, just like AMP, just like Lendlease, just like a number of others, Helios, for example, they will have a rally in the share price. Bravo if you're on board. But I tend to judge investments on a longer run, and they are really not worth having in the longer run, in my view. They will not give you a great return. The challenges coming towards Ramsey go well beyond a large mountain of debt. And it's very simple. I mean, in all the countries that they operate their private hospitals, there is pressure on the system, and governments are not really prepared to jump and become the white knight for the sector, essentially. And the other thing is, which I always had in the back of my mind as well, if you talk to nurses, they are underpaid. They are severely underpaid, and they're basically being treated like modern slaves. Any business model that is based on that principle, sooner or later will end up in trouble. And I think the private hospital sector has met that point, I think. Hereby, I must say, we obviously have been going for a while. I do not have any more questions. So unless I'm getting more questions, it's time for me to thank you all for participating tonight. If we do have any more remaining questions, I'm more than happy to address them in my writings the coming weeks. We obviously are now concentrating on the results season. It'll be among us pretty soon. I probably have waited too long to do this. The promise hereby is to do this, to not wait as long for the next time. Just got an extra question in. We're gonna finish with that one. What medium large cap stock would I buy now? Let me answer that one with if from a personal perspective. We recently added Macquarie Technology to the portfolio. That I think is already up 10%, but that share price can do a lot more still. Underpriced, it's AI, it's data centers. One of the reasons why we owned it, we thought it was just way too cheap. So we added that one to NextCC and to Goodman Group. We also own Dicker Data, which has recovered in July, but could do a lot more. It might be early in August, but you know what? We just spoke about dividend payers. They do pay a nice dividend, and you can wait in the meantime. We also own Woolies. Might be too early. Illegal tobacco sales will have an impact. Inflation will have an impact. Pressure on household budgets, all impacts. But I would definitely keep stocks like that on my portfolio. If it wasn't for a certain Kennedy and his anti-vaxxers in the US, I would definitely add CSL. But you have to take that risk at this point in time. You just have to take that risk on board. There's just no ways about it. The company can't do anything about it. I certainly can't either. And that was the dance for tonight, I think. I see that some of you have liked the session. As I said, thanks for turning up. Has been a great experience. We do this again. But first we're gonna have August reporting season. Thank you all, guys.